Welcome back, my finance peeps. We're now in reporting season where you're getting reports left and right from Australian and US companies. And we've got the big tech boys in Facebook, Amazon, Netflix all coming out, with Facebook being one of my favorite American stocks coming out with some decent numbers, showing stability, showing those big Zuck bucks. Which, I'm not really surprised. People are at home, they're connecting on Instagram for my young peeps, Facebook for my older and younger peeps, and WhatsApp for my peeps who just don't use the other two. But yes, things are looking up, including the bank shares. Although it's odd because that's not what reports would have you believing, with headlines including 50% dips in profits for both NAB and ANZ. But with such big drops, I want to take a dive into some of the numbers the banks have provided, in particular NAB. But of course, before we go into the video, it'd be greatly appreciated if you guys could smash the like button so that other finance folk and peeps out there can find it also. That'd be greatly appreciated, guys. Anyways, let's get into the video. So let's get the big headlines out of the way. NAB has recorded a $1.4 billion loss in cash earnings, which is 51.4% down. And given the first half, or the first quarter, was pre-COVID, you can imagine the second half of the report is going to be even more worse. But that all depends on the scenarios we'll see in the second and third quarter, which has been hotly debated at the moment. But no one really knows until things start opening up. So no matter which scenario an analyst or a bank's put up there, they're basically guesstimating on an Excel spreadsheet or a graph what's really going to actually happen. On a big picture perspective though, NAB's business and private banking sector is down 5.7%, which was a result of lower fee income and lower earning rates on deposits. This is a result, of course, of the lowering interest rates to promote consumer spending and taking on debt by the Reserve Bank of Australia, or the RBA. Now, this is great for the consumer if the rates get passed on, because generally the RBA might give a rate, but then whether it gets passed on is a totally another story. And I'm not trying to name any banks in particular, but But anyways, consumer banking, though, has gone up by 26.4%, which is a result of lower funding costs because the rates have gone down, which means it's easier for the banks to get cash. And also one thing to remember, these numbers are boosted because NAB owns UBank, which is currently one of Australia's best online banks with a very good interest rates in their savings account and has been one of the top ones for a couple of years now. A bigger dip has been in their corporate and institutional banking department, which was dragged down by 10.2%. which is again a result of the lower interest rates and some competitive pressure impacting their margins on business lending, as many other banks try to compete with more customers, particularly the ones that are starting to move online. So everything at the moment is kind of down and we expect that, but I want to have a look at the forecast and the merchants under NAB who have taken the biggest hit. So based on their modeling and the info they've received, NAB believes that the GDP won't be back until early 2020 or late 2021. But that's odd because that's not what the stock market would have you believing. Because if you had a look at the indexes and the stock market, you'd be looking at these analysts and bankers and thinking they're absolutely crazy for thinking this is going to take a year or two to kind of resolve itself and get the economy back to normal. But what you'll notice is banks like Goldman Sachs are also saying this is going to take about a year or two to recover. And remember, these forecasts are all assuming that we don't get another wave. And I'm guessing the 2-year period is also to allow for a vaccine to be developed and for consumer confidence to rise back up to that 100% again pre-COVID. Now, if we look at the sectors that are most affected, I don't think we'd be very surprised. We can clearly see here the hospitality sector in accommodation and food services has gone down about 70% in payments, followed by the recreational services, transport, and manufacturing. Now, I really like this graph because it's super insightful, as I think this speaks also to the trends of future jobs, especially when I think about all the businesses now who have been digitized and have put their businesses online and are starting that transition from retail to e-commerce. And as they make that transition, they see the benefits in reducing overhead, the benefits of building that relationships with customers and going directly to them as opposed to some middleman or setting up your own brick and mortar. And I had a chance to listen to Facebook's quarterly reports and announcements, and Mark Zuckerberg pretty much said that he and the team at Facebook were helping small businesses kind of integrate this and make this e-commerce thing a possibility. Because people aren't able to go to shops anymore, they're moving on to an online platform in Facebook. And once businesses move on there as well, they can start making these transactions still happen with or without a shop, without having to go to the shop itself. Now, what might be interesting is that NAB has slashed its dividend and has continued to pay it at 30 cents a share, which is a huge reduction of 64% to strengthen its financial position. Now, I like that the payout ratio is only at 35%, and this is similar to actions that banks had taken in 2008, which can be seen here in Commonwealth Bank. But given the dire forecast, you could only question why not hold on to the cash to bolster your balance sheet instead of paying it out. Now, NAB's obviously taken this under consideration, and so has ANZ in deferring their interim dividend. But under the APRA guidelines, they have gone through stress tests, so it's not like they've delivered these dividends without giving it a thought. And I think they're doing this to try to instill good faith by assisting some of their shareholders in providing some form of further income that many would rely on, especially those who are retirees. In line with many of the other banks, NAB has deferred mortgage repayments, which is why I don't think the banks have seen a lot of grief from the public news or the public in general and the markets in terms of their share price. But I want to make one thing very clear. Although this may sound good, and it is good in the short term, I want to remind everybody that this isn't forgotten debt. Borrowers will still have to pay this interest that accrues over this holiday period for repayments. Banks are businesses, not charities. So they still need to get paid that interest money for the money they had loaned you before. Now, NAB at the moment has approved 70,000 deferred home loan repayments and 34,000 business loans, which both total to $44 billion in loans. Now, due to this fall in future cash flows because of the deferred payments, you'll see most of these banks now have what's called an impairment charge, which is a non-cash expense, basically writing down the value of their current assets in anticipating the fallout in poor future cash flows. These are generally done when there's an unforeseen economic or legal event that might upset the value of the assets, in contrast to the cash flow these assets would have provided in the future. Now, I won't go into too much detail about their capital raising because there's lots of banks that do this when regulations change and governing bodies force them to bolster their cash reserves. So, just some basic dilution of shares going on here and there. But what I will say, and seems promising, is that there are many firms willing to take on that $3 billion raising, which shows confidence in NAB. And if you're a current shareholder, the price of the SPP is rather attractive too. So given most banks will go through a similar scenario, what do you guys think about the banks at such low PE ratios of 10 or less? For me, it's kind of tough, right? Like, it seems like a good deal, but if you already have an ETF or a LIC, you're already heavy in those banks anyways. So if you're looking for growth in the future, I would definitely not be going into the banks given the lower interest rates. And in my personal thoughts, general advice, not personal advice, I wouldn't be buying shares just now, and I also wouldn't be going conservative if I was purchasing anything, because the companies that can make it through this tough period are going to do very well in the future. That's just my thoughts, guys. I thought I'd put a quick video together about the NAB capital raising and just some quick thoughts about the banks. If you want me to talk in depth about some more banking stuff, I mean, I can, but it's not that fun. Like, they all kind of do the same thing and rely on the same thing. But yeah, anyways, that's it for me, guys. Enjoy your weekend. Have a good one. Catch you guys later. Bye.